we may have lifetime warranty or so we have to decide so whether we have to install a solar system for our own house, own business, right? So then we can work without having this solar system. But if you introduce this solar system, it will affect for the long term period. So we have different types of benefits, right? Different type of benefits due to this solar installation. So what are the benefits obtained from this kind of long term investment decision? By installing solar system, doctors, please highlight. Sometime you also may have this. Yeah, doctor.
Savings from electricity bills.
Yeah, you can save your
Also, some tax
benefits from this kind of thing.
relaxation.
Yeah, we
Tax
can sell this
relaxations.
excess capacity to the national grid under the electricity board, Ceylon Electricity Board, CB, right? So then there is another benefit. So inverters, right? Cables. Then there may be number of other factors as well, right? Other factors as well. So then we want to highlight those matters here. That is one kind of long-term investment. Today we are spend money on this particular task, but the benefit will arise during the lifetime of this particular solar system. It may be 10 years, 15 years, 20 years, 30 years. Likewise, that is depend on the agreement with the particular service suppliers, right? I think you got this point clearly, right? Now should we open another store or expand the business, right? Open an online store, right? So then we have to again evaluate this particular long-term decision. These are relevant for future period with the agreement. So it may be 10 year, 50. Uh, uh, Particular place. So those are the long-term investment. Should we start this new business, right? In addition to the existing business, so shall we start new one or not? So we have to make this kind of decision. These are long-term investment decision, right? Then actually capital investment decision, it's a process. I'm not going to read each and every slides here, so I skip some slides. You can read it and understand it well clearly. Then if you go to the importance of long-term investment decision, you can see long-term implication of capital budgeting. So it long-term effect of the this kind of capital budgeting on profitability, involvement of large and heavy investment, as you know, right? So if you think about the solar system, if you are introducing 10 kilowatts or the 10 kilowatts capacity, 10 watts, right? 10 watts capacity
Sir, excuse me.
solar system. So yeah,
Sir, there is
yeah.
an interrupted sound.
Sorry.
Interrupted, me, sir.
Can't you hear me well? Yeah.
Sir,
Yes,
always
sir, interrupted.
Yes, sir,
interrupted
sometime.
and freezing always.
Yes, sir, always interrupted. We couldn't heard correctly, actually.
What is the reason behind that? My connection is so good. What is the reason? Now can you hear me well? Now is it clear?
Now okay, sir, but there was a interrupted.
Yes, sir.
Can you see the PowerPoint as well?
Yes, sir, we can see PowerPoint. The problem is the sound.
Uh, uh, okay. Then I will explain. If you have a similar situation again, then you can mention it, right? Right. Then what is the importance of
Okay.
this capital budgeting decision, right? Long term implication of that mean it will affect long term period, involvement of large and heavy investment, irreversible, as I mentioned earlier. We cannot reverse this kind of investment after making a decision, right? So if we, for example, if you decided to purchase purchase a that mean large scale CT scan machine. So after purchasing, so we cannot reverse it, right? We cannot uh, send back to the suppliers, and we cannot sell for other persons or other institutions without making a loss, right? So there are some reasons to say this is a irreversible decision. So we cannot reverse this kind of decisions. Therefore, we before purchasing this kind of event or constructing a building, so we have to think in detail and in deep. So then we can make the decision. Otherwise, we cannot change the decision. Then we are working under the risk and uncertain condition, right? So because our that mean lifetime of this particular project is very long. It may be 10 years, 20 years, 30 years, or more than that. So therefore, we cannot predict each and every situation in future. So therefore, we are working under the high risk and uncertainty situation. Therefore, it is important to uh, pay attention to the risk and return as well. Then difficult to make a decision in capital budgeting, because today we are making decision on behalf of different future time periods, right? Uh, then again under the different political economic situation, technological changes are there in future. So as you know that nowadays we are working under the AI, right? AI, then we are working under uh, high tech situation. So in future, we cannot predict future application in AI or any other technology. Now today we are talking about AI. So in future we can see a different version of AI or different application of AI or other terms. Now today we are using AI, but in future we may have another new concept to apply in our business or affect to our business, right? Therefore, with the again we are working under the risk condition. Maximize the worth of equity shareholders. So another one, we always think about the way of maximizing the wealth of equity shareholders or the real owners of the business. So again, we have to make a long-term decision with that limitation, right? In order to earn or maximize the worth of shareholders, equity shareholders. Complexities connected with each project, national importance. So actually, nationally, very much important to invest in long-term assets. It is difficult to manage a long-term in every types of long-term investment by the government, right? So then private sector long-term investments also very much essential to achieve the target of the government, right? So again, a nationally important task here under the long-term investment, right? So if I think about the healthcare sector, right, capital investment in healthcare sector is the process of evaluating and allocating funds to potential major projects, investment, building or the infrastructure improvement, developing computerized system, or the purchase of durable goods such as bed or equipment, right? So those are the long-term investment for a hospital or the for uh, health ministry, right? So we have to think about it, right? Then another system. So we have developed other systems to overcome some kind of issues in management management in our healthcare sector. As you all know, as a doctor, what are the major issues of your hospital, right? Most of the Western hospital now today we are talking about the unavailability of medicine or different types of vaccines. So we have no that kind of particular vaccine or other treatment in the government hospital. So what are the reason behind that? The major issue behind that is inventory management issues. So in order to manage inventory, so sometimes you can introduce new computer system to order and identify the uh, particular uh, uh, scarcity of medicals or the issues with the different medicines, right? So then if you are going to introduce new system, integrated system by paying for a outside uh, IT firm, so then it will be a great opportunity for next 10 years or 15 years time. So that is also long term investment, right? Then we can see different types of a long term capital budgeting investment in health sector, right? So you also can think with your own idea, own experience. I think you have more experience in that particular industry, more than 30-20 years sometime, right? 20-30 years. Therefore you can see what are the required equipment, long term equipment, long term assets, long term that mean uh, building and other requirements. So everything you can consider as your long-term investment in health sector, right? A healthcare system might, for example, use capital budgeting to review a proposal for the constructions of a new hospital wing or acquisitions of an outside physician's practice before approving or rejecting the project. So here again we have to think about the application side or the investment in long-term investment in health sector. Using capital budgeting calculation and analysis, healthcare organizations can make informed decisions around potential investment, purchases, and project. Right? For example, option yeah, opt-in participate in region or the national wide care delivery network, which involves pursuing affiliations and partnerships that may require significant capital investment. Another one, moving forward with the acquisition of a private physician's practice, building a new hospital with purchase new imaging equipment. Then overall capital budgeting helps healthcare organizations select profitable projects, identify sources of funding, and control capital expenditure, right? So again, you can see details about the purchase in long-term investment in healthcare sector. What are the major investment as mentioned here? You can see long-term investment in assets like building, major equipment, and advanced technology, and so on. Right? Then type of capital investment. Right? So we can see different types of capital investment. Right? First one, on the basis of firm's existence, right? Then we can classify some yes investment based on different scenario. One is the on the basis of firm's existence, another one on the basis of situation. First one, under the first category, on the basis of firm's existence, modernization asset decisions, replacement or modernization decision. So what is the idea behind that? Replacement or modernization decision. So at that time, actually, we are a existing business. We have existing business. So, for example, we are operating a private hospital, right? We are operating a private hospital. So here we have CT scan machine, as I mentioned earlier. Now we want to acquire a high tech ICT machine, right? ICT machines, and we have to replace the existing machine instead of the that means instead of the existing machine, we have to replace the new one with higher technology, right? That is the replacement decision. Another one is the expansion decision, right? Now here we are conducting hospital facilities, so the dispensary hospital facility. So we have to introduce new pharmacy, or otherwise we are conducting a textile. Now we want to add some uh, uh, huge pharmacy. So then we are diversifying our business, right? That is also expansion, right? Expansion decision, right? For example, now we are producing toothpaste. That is our main product, toothpaste, right? We have number of toothpaste or number of sizes of toothpaste packet. So based on that, we are producing the. So in addition to that, if you want to add another section like one sections to produce toothbrush, that is the expansion of that particular business. Expansion of that particular business, right? So otherwise, now we are conducting a hotel, right? We are operating a hotel, right? Now in addition to the hotel facilities, now we want to add some spa or the other Ayurveda Panchakarma center in addition to the hotel. So that is also expansion. Jointly we can arrange that place for our tourists or foreigners. So that is also expansion of that particular business. That is effect for the loan time period. Another one, diversification. Diversification means again similar type of expansion. So in order to diversify, as I mentioned earlier, that toothbrush and into the toothpaste producing company. So likewise, we can see different diversification, right? Instead of the similar center, similar product, so we can diversify. So we are diversify our tourism industry into medical, right? Likewise, we can see different applications, right? Then that is three types of major classification of long-term investment based on the existing firms situations, right? Next one is the on the basis of situation, right? Existing now based on the situation. Now we can identify mutual exclusive decision. Mutual exclusive decision mean if we make some decision, so it will affect to the affect to another decision, right? Then next one is the accept reject decision. So accept or reject decision may be there. Contingent decisions also there, right? Then you can see the independent project. Another one, independent project. If it is an independent project, what is the idea behind that? Independent projects are those where the acceptance or rejections of one project does not affect the acceptance or rejections of another project. That is the independent one. Each project is evaluated independently. Example, consider a company that is evaluating two distinct projects. One involve expanding the current product line, and other involves developing a new marketing strategy. For example, here Project X, product line expansion, Project Y, market strategy development, right? So those are Project X and Y are uh, independent uh, uh, projects. So next one, mutually exclusive project. If you accept one project, then definitely we will be able to reject another project. That is the nature of mutually exclusive project, right? For example, a company that is considering two different machines for an expansion project. Both machines perform the same function, but they have different cost, operational efficiency, and expected cash flows of machine A and B. Based on that, so we have to uh, yeah, we have to select either machine A or B. We cannot select both because of this mutually exclusive type of the project, right? That is regarding the uh, mutually exclusive project, or the so mainly we focus on the independence of each other. Then next one is expansion decision. So so you can see number of example. උදාහරණ ගොඩක් තියෙනවා මෙතන. So you can see that, right? Here you can see one example. Here production facility expansion, increase the production capacity to meet growing market demand. Investment is 2 million or 2 billion time. Details. Additional machinery and equipment, expansion of existing facilities, right? Expected outcome, increase production capacity by 30%, capture a large market share, enhancing overall revenue and profitability. Right, replacement decision, that is also you are given examples. I am not going to discuss it detail. Then if you go to the process of capital budgeting, it's a process, as I mentioned, it's a planning process, planning and monitoring process. Then first one, identify the investment opportunities. Now, for example, now you have excess capacity or excess money, 10 million. You have 10 million investment. So then what type of investment you have? So you have to evaluate what are the available investment opportunities, their relevant return and relevant conditions, whether you have to pay tax based on this particular investment or not, right? So you have to evaluate everything. Then we can then only we can make decision. First one, so you have to identify investment decision or investment of available investment opportunities. So that is the, yeah, you can invest your 10 million for starting a communication center, for starting a for purchasing gold, for investing in a stock market. Likewise, we can see different options. So first of all, we have to identify what are the available options to invest our money, excess money. Then next one, evaluating feasibility and cash flow projection. So we have to forecast the future cash flow benefits due to this kind of long-term investment, whether we purchase an equipment or we are constructing a building. So we have to have some estimations, future cash inflows, outflows, that then those we need to have a breakup of that. Then selecting project. So based on the that mean based on the estimated figures, so we can ultimately accept or reject the project, right? preparing an appropriate budget for that, capital budget we have to prepare based on the given expenses, implementing projects. So after completing those things, we can implement it and review of performance. So that is the overall process. Now here again, we can simplify this process into few of them, right? You can see if you read this chart, clearly you can see what is the process of capital budgeting. Capital budgeting. Then identify the potential investment opportunities, estimate net cash inflows and outflows, right? Analyze the investment using different evaluation technique, choosing most valuable project or important project out of number of available projects. So we have to decide, then only we can post audit to measure outcome or feedback or review of the performance. So that is the normal procedure of evaluating long-term assets or long-term investment, right? Then first one here, as I mentioned earlier, then in this process, first task is to identify the available opportunities, right? So what are the opportunities? First step is to identify or finding investment opportunities. Here you can see what are you looking for an investment. How can you afford to investment? How long you are willing to wait for return? Then how much risk are you comfortable with? So likewise, there are number of evaluation part, number of selection part here. Then then we can identify the requirement through the through this process, right? Through this capital budgeting investment procedures, right? Then you can see research the market. So we have, when you are analyzing your available opportunities, so we have to analyze the market, right? Then second, estimation of future cash flows. Future cash flows mean cash inflows and outflows. මුදල් එනේවා සහ ව්‍යාපාරය තුළට මේ ව්‍යාපෘතිය හේතුවෙන් ඒ වගේ ව්‍යාපෘතියෙන් එළියට යන මුදල් ප්‍රවාහ. So we have to estimate those things. So sometimes we have to forecast it, right? Then when you are estimating, so we can see three types of main estimation here. One is the initial cash in outflows. What are the initial cash outflows? What are the initial cash outflows? Yeah, then that is the initial cost of our investment, right? So you can obtain this figure in different way. The second one, interim incremental net cash flow, right? Incremental incremental net cash flows. Those cash flows, not net cash flows occurring after the initial cash investment, but not including the final periods of cash flow. Terminal year investment means the final period's net cash flows. So I think you have no issues with that. So if I move to the second part now, first part is to identify the opportunities. Next part is to estimate the cash flows. So how to estimate the cash flows? So we can see different types of process, right? Initial cash flows, how to determine initial cash flows. So how to obtain the initial cash flows? Initial cash flows means you are going to purchase a scan machine. So that is the cost of that particular scan machine, purchasing amount. Then you can see some cost for transporting that particular machines to our production place, right? So then we can see that some kind of cost, shipping costs, that mean handling cost, there may be number of cost items behind that. Then the increases in working capital, that part also part of our investment, part of our initial cash flows. After tax non-capital expenditure. So then you can see number of items here relating to the related to examining the estimating initial cash flows. Right. Then replacing decision, you can see starting from the proceeds of sales, then the current book value, then you can see the profit and loss. Right. After then you can reduce taxes, after tax profit and loss, after all taxes. So then we can select after tax cash inflows. So you can see the way of converting cash flows and rupees, right? So normally cash flows, if you have rupee value, if it is around 3, so then we can see Indian if you think about the purchasing of new assets from India, right? So then we have to think about the we have to think about the replacement existing machine. So how to replace existing machine? So we can sell existing machine for a particular amount, right? That is called salvage value, the residual value. So then that is the negative part of our initial investment, right? So initial investment on huge CT machine from India, or not only India, or China, or Japan, or any other country, France. So you can obtain them. So with the existing machine, old machine, so we can replace new one. Then we can sell existing old machines for a particular amount. So that is the reduction in our overall investment. So we have to have this kind of clear idea, right? Here you can see another example for determining the annual cash flows. This is regarding annual cash flows. So how to determine the annual cash flows? Annual cash flows is annual revenue. In different business, we can see revenue or the sales. If you think about the manufacturing company, we can see the sale. But if you go to the service-oriented one, we can see revenue. Revenue minus the overall cost minus depreciation. So we can see the profit before taxes. Then we can reduce tax on profit before tax. Then we can see the profit after tax, and again we can add back the depreciations to obtain the cash flows before tax, right? If you go to terminal cash flows, what is the terminal? Now we discussed 3 types of cash flows. One is the initial cash flows. Initial mean cash flow outflows, net cash outflows at the beginning of the period. ව්‍යාපෘතිය පටන් ගන්නකොට ඒ සඳහා යන පිරිවැයක් යනවා. ඒ අතරතුර යම් ලැබීම් තියෙනවා. So after reducing the initial cost from the initial investment, so that is called the initial cash flows. But second one is the annual cash flows. Annually we can see reduction of cost, increment of sales, or the decreasing of sales. So likewise we can ultimately obtain the existing cash flows, annual cash flows. Another one is the terminal cash flows. That is the cash inflows or outflows at the end of the project, right? That is called terminal cash flows. Terminal cash flows. Right. Now, if we go to this kind of example, so you can see you are given this details. Revenue is 1,000, cash expenses is 600, depreciation expenses 200, profit before tax 200, taxes 70, then net net income is 130. So you can see the 130 here. Right, this is the net profit or profit after tax. Profit after tax. Now you want to obtain cash flows after tax. Cash flows after tax means profit after tax plus depreciation. Right. Then here cash flows after tax, again we can obtain revenue minus cash expenses minus taxes. So again you can see the same answer as mentioned here. Capital budgeting evaluation technique. So next one, so if we go back to the process again, right, this process, so you have to have first one is here, identify the available investment opportunities, then estimate cash flows. So after estimating, then we have to evaluate the investment opportunities or the proposals or the appraisal based on the given information. So that is the third process of this particular analysis. So the evaluation or project evaluation process. Choose the most viable project. So after this particular process, so we can go for the choose. It is better to choose most viable project. So next, last one is post audit to measure outcome. Right. So those are the capital budgeting process. Right. So then we already discussed this one, identifying the identify the potential investment opportunities, then estimate the net cash inflows. Next one is analyze investment using investment appraiser. So now we are at this point. Right. Now this is regarding the initial cash investment. Then cash flows from operations. Here you can see. Right. So then our main task is to evaluate our long-term investment opportunities. Right. Now we have number of traditional and cash flow technique, discounted cash flows technique to evaluate different types of investment opportunities after estimating your cash flows. Right. So now under this process, first part is to design part is there. Next part is to yeah. First part is to identify the opportunities. Next part is to uh, uh, estimate in cash flows. Then third one is the evaluating cash flows. So when if you want to evaluate the cash flows, right, there are a number of methods, right. One is called traditional method, traditional technique, as mentioned here. Yeah, traditional method here. Traditional method. So we can see two types of traditional method: payback period and accounting rate of return. So then next one is the modern technique, or otherwise we use the discounted cash flow technique. Under the discounted cash flow technique, so we can see number of methods here. Right. There is a summary of our capital budgeting process. Right. So here cash flow estimation. So then how to estimate the cash flow: sales minus variable cost, contribution you can obtain. Actually, contribution concept, this is directly for the management accounting. In financial accounting, we are not talking about the contribution, right? So after reducing variable cost, total variable cost from sales, we can obtain the contribution. That is very much important in short-term decision making, especially, right? Then less cash fixed cost, depreciation, profit before taxes, profit after taxes, depreciation, cash flow after taxes, right? So we can see this kind of thing, right? This is the cash flow estimation, right? Now, if I move to the number of uh, project evaluation technique, I think it is better to take a small break, right, before going into this important task. Right now, we have to identify the investment opportunities. Then we have to estimate future cash flows. Cash flows mean cash inflows and outflows due to this investment decision, long-term investment decision. Then we discuss those things. Now, third part is to evaluate our cash flows, so the project, right, by using suitable analytical technique. Right, there are a number of analytical technique. One kind of category is called uh, that is traditional method, payback period, and the accounting rate of return. All others are called discounted cash flow technique. Right, discounted cash flow technique we can discuss one by one, right, one by one. So I'll take 5 to 10 minutes. Because of this time, it is better to have refresh, right, before starting this particular topic. Is it okay, doctors? Can you hear me well?
Yes, sir.
Right. I already explained about the brief about the content and the process. Now we are at the very important stage to evaluate our investment opportunities, or a project, or in evaluating projects, right? So we can start after 10 minutes break. Okay, doctors, I think you all came back to the discussion. Am I correct? Can you hear me well?
Yes, sir.
Identifying different types of investment opportunity and estimating cash flows under three categories: initial cash flows and also annual cash flows and terminal or cash flows at the end of the project, right? If I say a few words in singular, right, I think that is also important. Otherwise, you can. This is somewhat different subjects from field. Therefore, I'll take a few minutes as per some request, right? Then ඇතරම දැන් මේකේ අපි කරන්නේ දීර්ඝකාලීන ප්‍රයෝජන ලැබෙන ආයෝජනයක තමයි අපි මේ ආයෝජන සම්බන්ධතාව මේ තීරණ ගන්න. හරි? එතකොට අපි කරන්නේ මොකද? ඉස්සෙල්ලාම අපිට තියෙන
Sir,
දැන් ඉන්නේ
Interrupted.
sorry
interrupted again, sir.
again interrupted.
Yes, sir.
Yes, sir. Again connection is good. Connection is good. Okay, right. I'll change the connection. Now, can you hear me well, doctors?
Now
Now
okay,
okay,
sir.
Right. Then again, I explain a few words in single as well. අපි ඉන්වෙස්ට්මන්ට් එකක් තෝරාගත්තට පස්සේ ඉන්වෙස්ට්මන්ට් එක තෝරගන්න කොහොමද කියන එක තමයි මේ ඉවැලුවේෂන් ටෙක්නික් වලින් අපි බලන්නේ. තර්ඩ් ස්ටෙප් එකේදී බලන්නේ විවිධ අවස්ථාවන් අපි අඳුරගත්තට පස්සේ ඒ අවස්ථා තුළින් වඩාම හොඳ ඉන්වෙස්ට්මන්ට් ඔපොර්චුනිටි එක හෝ කීපය තෝරගන්නේ කොහොමද කියලා. හරි, දැන් ડોක්ටර්ස් මම කිව්වා වගේ 10 million ෆන්ඩ් එකක් ඕන ඉන්වෙස්ට් කරන්න මුදල් ප්‍රමාණයක් තියෙනවා ඉන්වෙස්ට් කරන්න හරි කොහොමද ඉන්වෙස්ට් කරන්න පුළුවන් ඔන්න FD ඕතන් අපිට treasury bill ගන්න පුළුවන්. හරි, අර මම ඉස්සලා කිව්වා වගේ ඉන්වෙස්ට් කරන්න පුළුවන් විවිධ විදි තියෙනවා. බිස්නස් එකක් නම් අපිට පුළුවන් එක්ස්පෑන්ඩ් කරන්න, සෝලාර් වල ඉන්වෙස්ට් කරන්න පුළුවන්. හරි, ඒ වගේ කතා කරනවා. ડોක්ටර්ස්ලා පර්සනල් ඉන්වෙස්ට්මන්ට් ඩිසිෂන් ගත්තත් ලොන් ටර්ම් ඉන්වෙස්ට්මන්ට් කරන්න පුළුවන් එක එක ආකාරයට. බිස්නස් එකක් පටන් ගන්න පුළුවන්, තියෙන බිස්නස් එකක් එක්ස්පෑන්ඩ් කරන්න පුළුවන්. හරි, ඒ වගේ විවිධ තීරණ වලට යන්න පුළුවන්. කම්පියුටරයිස් සිස්ටම් එකක් ඩෙවලොප් කරගන්න පුළුවන් එක්සිස්ටිං බිස්නස් එකට. හරි, මේවා තමයි long term decision කියන්නේ. ඒක කරගන්න ගියාම you may have number of option. You may have number of option. එකම දේ කරගන්න ගණනාවක් තියෙනවා. right? ඒ අතරින් වඩා හොඳ එක තෝරගන්න කොහොමද? ඒකට තෝරගන්න ඉස්සෙල්ලාම ඒවට cash flows estimate කරන්න step එකේදී what opportunities කියලා අපිට අපිට මේ විදියට අපි opportunities පහක් ඒ පහින් එකක් තෝරගෙන පහට දාලා cash flows අපි estimate කරන්න ඕන. හරි, එතකොට ඒකට කොච්චරක් cost එකක් මූලදී ආයෝජනය කරන්න ඕන. ඊට පස්සේ වාර්ෂිකව අපිට කොච්චරක් ඒක නිසා benefit එකක් එනවද? ඒගොම වර්ෂ ප්‍රොජෙක්ට් එක අවසානයේදී මේක asset එක නැවත විකුණන්න පුළුවන්. එතකොට ඒ තුල උද්ගත වෙන cash types of major techniques. One technique is called traditional technique. සාම්ප්‍රදායික ශිල්ප ක්‍රම තියෙනවා. එකක් තමයි payback period එක. අනික එකයි average return of rate of return at the accounting rate of return කියලා කියනවා. These two are under the traditional technique. In addition to that, we have discounted cash flow technique. Right? Discounted cash flow techniques, we have a number of things. One is the other one is uh, profit other cash. So now we have to have good idea.
Excuse me, sir.
What was?
Sir interrupted me.
What you are going to ask?
Sir, sound is not clear, sir.
Sound is not clear.
Interrupted here.
Now I will. Now it's it okay. Now I improve the volume of sound. Now is it okay?
Oh, sir. Still interrupting, sir.
Still, sir.
Now sound is, you are talking about.
No, sir. Continuously we
break.
can. Yes, sir. Interrupted.
Interrupted. Now okay.
Still not, sir.
Can you hear me well now?
Not yet, sir.
Doctors, now is it okay? Can you hear me well now?
Now okay, sir.
Right. Then if it is interrupting, then you can highlight again, right?
Okay, sir.
Right now, as I mentioned earlier, we have to invest in long-term investment project, right? Then first of all, we need to understand what are the available opportunities to invest. That is the first step. So after getting them, so if we identify most suitable 5 investment opportunities, so then we have to have some estimation about the different types of cash flows. So initial cash flows mean at the beginning, so how much we need to invest in that particular project. So then annual cash flows mean annual. What terminal cash flow mean? What is the cash flows arising at the end of the project? So then we have to have clear estimation. That mean estimation or the forecast about the cash flows. That is the second step. Then the third step is to evaluate cash relevant projects by using different technique. Then we divide technique into two. One is the traditional technique, another one is the discounted cash flow techniques, right? There are two types of traditional techniques we are going to discuss. One is payback period, another one is the accounting rate of return or the average rate of return, right? Then there are a number of discounted cash flow technique, net present value, internal rate of return, that is profitability index. There are a number of other techniques. Now we are going to start traditional technique. Under them First one is payback period. In Sinhala, we are using the term Pililadu Kale, Piligeum Kale. So actually, this is mainly focused on, yes, how many years it will take to cover the initial investment. So after making investment, how many years it will take to recover it. That is simple thing, right? So if we receive that kind of benefit annually, or the same amount annually, so easily you can obtain, that is for the uniform cash flows, you can obtain payback period initial investment divided by the annual cash flows, annual cash inflows, right? For example, now if we invest 20 lakh, or 2 million rupees on your solar system, right? Solar system. So annually you can save 200,000 rupees from this particular investment for each year of the during the project, right? So if we divide 20 uh, uh, lakh, or the 2 million, by 200,000 or 2 lakh, then your payback period is 10 years. What is the idea behind that? If you invest 2 million rupees today on solar system, so you can recover this particular amount within 10 years period. Then 10 years is the payback period. Then your payback period is 10 years. So if you have number of options for installing solar system, right? Number of suppliers are there. Then you may have different payback period. One from yes, one organization says their payback period is as per the cash flows, after calculating payback period is 9 years. Another one is 10. Another one is 12. So which is the most viable project based on this payback period method? Yes, you can see 3 payback period, right? 3, yeah, you can obtain, you can start the project, right, under three scenario. Then 3 suppliers are there, right? As per the first supplier, your payback period is 9 years. Second one, 10 years. Third one, 12 years. So which is the most suitable project for investing in
Nine.
on this? 9 years, yes. Yeah, because we can recover our initial investment with shorter period, right? Then that is the most viable project. In some organizations, they are having some policy, right? If the initial, that means if their payback period is 5 years or below, then they accept, otherwise they reject the project. So then at that time we have to think about that kind of threshold level, right? However, we have to compare payback period, we have to accept the lowest one. So that is the normal way. So if you have uniform cash flows, you can do this task, because initial investment divided by the annual cash flows, cash inflows, right? Net annual cash inflows. But unequal cash flows, you know that benefit, it will change year to year, right? We cannot expect exactly same amount during the lifetime of the project. So if it is change, so what will be the treatment? So calculate the cumulative cash inflows. So year by year, we have to reduce that particular amount, and ultimately we can obtain the payback period. So we have to prepare a table to show the cumulative cash flows. For example, now initial cost is 20 lakh. So then within first year we can cover 300,000. So then divide, yes, reduce 300,000 from 20 lakh. So then 17 lakh. Then 17 lakh again, within the second year we can cover another 200,000. So then again 17 lakh minus 200,000, 15 lakh. Likewise, we have to prepare a separate table to obtain that particular payback period. How many years it will take to cover our initial investment. So then that is the another way. So however, after getting that, then you can compare number of options, then take the lowest one. So that is the way of doing that. So you can see payback period is the amount of time required for the firm to recover it's how to make the decision. The project's payback period is less than the maximum acceptable payback period given by the management, then we can accept the project. Management, it may have some policy to accept or given benchmark payback period, we can make the decision. If the project payback period is greater than the maximum acceptable period, so reject the project. So that is the criteria for accepting or rejecting the project under the payback period technique, right? I think you can see it is very much clear. Can you hear me well again? Do you have any interruption, doctors?
No, sir.
Right.
Yes, sir, now okay.
All right. Then management, management determine maximum acceptable payback period. Then we have to decide our computed payback period is less than or greater than the management decided maximum acceptable payback period. If our calculation is less than the management decision, so then we can accept the project. Otherwise, we have to reject the project. That is the idea behind this concept, right? So then, if we are having the again then uniform cash flows during the next project period, right? Project lifetime. Then we can use similar formula as I mentioned earlier: initial investment divided by annual net cash flows, right? Then you can obtain the number of years, right? Then, for example, now project initial cost is 28,550, right? If you think about thousand in thousand or something, right? 28,550. Estimated lifetime is 4 years, 4 years project. Then estimated residual value, so the residual value or the scrap value, right? Residual value or scrap value, right? Scrap value or salvage value. We can use separate different words, right? Salvage value. This is called the salvage value or the resale value. Sumbun agaya, right? Sumbun agaya. අවසානයේදී ප්‍රොජෙක්ට් එක අවසානයේදී මේ තියෙන මැෂින් හරි මොනවා හරි අපි අලුතෙන් ගත්ත එක විකුණලා අපිට මුදල් කරගන්න පුළුවන් ප්‍රමාණය. හරි දැන් මේ කියන 0 මේක විකුණන්න බෑ යකඩ බරටවත් විකුණලා කීයක්වත් ගන්න බෑ කියලා තමයි මේක කියන්නේ. හරි? එතකොට annual net cash flows inflows cash inflows annual net cash inflows. දැන් මේ ප්‍රොජෙක්ට් එකේ ප්‍රතිඵලයක් වශයෙන් වර්ෂයකට අපිට රුපියල් 10000 ගානේ ඉන්ෆ්ලෝ එකක් තියෙනවා. 10000 ගානේ ඉන්ෆ්ලෝ එකක් තියෙනවා. එතකොට අපිට අහනවා payback period required rate of return එක මේක දීලා තියෙනවා. නමුත් payback period එක අහනවා. the payback period එක කොහොමද ගණනය කරන්නේ? දැන් හැමදාම එකම ගානක් යුනිෆෝම් රිටර්න් එකක් නම් තියෙන්නේ. යුනිෆෝම් කෑෂ් ඉන්ෆ්ලෝ එකක් නම් තියෙන්නේ. අපිට ලේසියෙන්ම payback period එක ගණනය කරන්න පුළුවන්. කොහොමද ගණනය කරන්නේ? initial investment බෙදන්න ඕනේ net annual cash inflows වලින්, right? Initial investment එක 28,550 divided by then initial cash flows, annual initial cash flows 10,000, right? So we can identify 2.855 years, right? Answer come under the years, right? 855 years. So if you want to convert this 0.855 into month, so you can convert this into month as well, right? So then 2 years plus then month mean 0.855 into 12. So if you multiply this by 12, right? So then you can obtain the number of month. Please tell me the answer. Then 2 years and what is the 0.855 into what is the answer? 8.855 into 12. Yes, approximately 10, no? Am I correct?
10.26.
Yeah,
10 months.
yeah,
10.
yeah. 10.26. That's the exact value, right? Then 2 years and 10 month or 11 month. You can say, right? Yeah. Then you can write it here. 2 years and 10 month or 11 month, right? Then 10.26 mean, yeah, approximately, yeah, we have to approximate it to the higher value, otherwise we cannot cover it, no. In order to cover them, so we have to waste at least then 2 years and 11 month, right? It is very simple calculation, anyone can understand, right? Easy to understand. I think you have no issues with that. Is it okay, doctors? Is it okay?
Okay, sir.
Yes, sir.
Right. Then if we go to another one, yes, again, how to calculate payback period if we are having unequal annual cash flow. So the that means unequal or the uh, different cash flows, annual cash flows. So at that time, actually, we have to prepare a table like this, right? So how to prepare a table? So for example, uh, if I take this example, right? Right. So if I want to yeah, take this example, right? If I take this example, right, I think you can see this one. Now project A. So how to calculate the initial payback period? This is for the payback period of project A. Payback period of project A equals, now you can see equal cash inflows during the lifetime of the project. Therefore, initial investment divide by net annual cash inflows, right? Then you can obtain 42,000 initial cash flows, then annual cash inflows 14,000. Then your answer exactly 3 years. 3 years. This is regarding the project A. But if you go to the project B, so how to calculate the payback period for project B? So we cannot apply this into this formula. Therefore, your initial investment is here. Then cash inflows also here. So then we have to prepare a separate table for that, right? We have to prepare a separate table for that, right? Separate table for that, right? Then you can see initial investment. It is here 45,000. In investment mean negative value, right? Negative value. So then you can see the cash annual cash inflows, right? Annual cash inflows year one. Your amount is 28,000, right? 28,000. So after now is 17,000. Am I correct? Negative, right? Then 45 minus 28,000. What is the idea behind that? Now we already recovered 28,000, right? So then year two, if you go to the year two is 12,000, right? 12,000. So 17,000 minus 12,000 mean. So further we have to recover. Further we have to recover 5,000. Right? This is the line where you want to stop our process. Now we have to continue this process, but now next time, yeah, previous time 17,000 we have to recover, but we have lower amount of recovery from next year.
Sir, again,
You have to
Sir, interrupted, sir.
what is the reason behind that? Now connection is full now. What is the reason? Can you hear me well now?
now again, okay, sir.
Right. Now you can see again. I will explain the same thing. Right. Again, explain the same thing. Here, we have to. Yeah, this is our initial investment. Is it okay? 45.
Yes, sir.
Recover 17,000. Within the second year, we can recover 12,000. Out of 17, we recover 12. Then remaining only 5,000. So after coming into here, we have to recover 5,000, but we have more than of line, right? Then your payback period for the for B project. So starting from here, 2 years, right? Plus 2 years plus. Now you have to recover, right? You have to recover 5,000. Recovery amount 5,000. Cover from the next year altogether 10,000, right? Then if you want to take this in month, so you can multiply this by 12. Then you can obtain answer. Payback period of project B is 6 months. This is 2 years and 3 months, 6 months. This is the exactly 3 years. Right? Is it clear how the way of calculating it? The way of calculating it? Is it clear for you?
Yes, sir.
Right. Right? Then easily you can compare these two. Then tell me which is the most viable project? Most viable project out of this A and B?
B, sir. Project B.
B or A? B or A?
B. B.
B. What is the reason behind that? We can recover our initial investment within a short period, right? When comparing with the project B, therefore project A. Therefore, project B is the most viable project with that we can accept because of the lower payback period. That is a simple thing. You all can understand, right? Is it clear for you? පැහැදිලිද? කොච්චර කාලයක් යනවද අද අපි කරන ආයෝජනය අනාගතයේ මුදල් ප්‍රවාහ වලින් ආවරණය කරගන්න. එච්චරයි. That's all. Is it clear for you, doctors?
Yes, sir. Clear.
Right. Next one, here you can see the similar example, right? Similar example. So you can prepare this kind of table to obtain the payback period. This is called cumulative table, right? Cumulative table. Cumulative table to calculate the payback period. Then this point is very much essential. So you have to recover 5,000, right? But you can see greater amount than this recovery amount in next year. Then this is the line. This is the place where we need to mark the line, right? Then here almost completed 2 years. Then 2 years here plus. Then we have recovered 5,000 out of 10,000. So then how many month? In order to obtain in month, you can multiply this by 12. Right. I think you got it clearly. Then we can go to the next example. So please compute the payback period of this particular project SNL, project SNL. Please compute it. Tell me the answer. Can you do that, doctors? Doctors, is it manageable?
Yes, sir.
Right. Take just 1 or 2 minutes to cover it. Yeah. Tell me the answer. Tell me the answer.
2 years and 5 months.
Sorry, 2 years
Project.
and
5 months. Project.
yeah. If we go to this S, then payback period of S. This is equal to Then again we can prepare the table as we discussed earlier, right? This is the way. Then initial investment, it is 3,000. Sorry, 3,000. Then the year one cash receipt is 1,500. Then remaining 3,000 minus 1,500 mean balance is 1,500. This is the negative value. So here also negative value, right? So then year two we can recover 1,200 from here. Then 1,500 minus 1,200. This is become 300. Again negative, right? Again negative. Then if we go to the year three, so then we can recover 800. That is the point where we can stop our process. Then 3,000 we have to recover 300, but we have more than that in next year, right? Then this is the place where we need to draw this particular line. So we can stop at this line. So then you can say payback period of this project X is 2 years, 2 years, 2 years plus. So 2 years. Yeah, 2 years plus
8 months.
Yeah. Then you can see you can cover 800 from next year, but we need to have only 300, right? Then into 12, right? So tell me the answer. 2 years and
5 months.
5 months, right? Then 2 years and 5 months for project S. Then if it goes to project L, so what will be the answer? Project L project payback period of project L. So then again we can prepare similar type of table, right? Then the initial investment is 300,000, similar to the previous one. Then cash inflows, net annual cash inflows, it is given year 1 is 400, year 2 is 900. So then if we reduce this one, your answer is 2600, again minus, then 2600 minus 900, then what would be the answer? 1700.
Yes.
1700. So year 3, so we can recover 1300. 1300, then remaining only 400. 400. So next one, year 4. Year 4, we can recover 1500. Right? Then again, this is the place where we want to draw this line. Right? Then we can say payback period of project L. So how to obtain this one? 3 years plus. So we can recover from the next year 1500, but just we want to cover only 400, then into 12 months. So what is the answer? 3 years and
4 months.
4 months.
4 months.
Right, 3 years and 4 months. So easily you can calculate it based on the given criteria. I think you got this point clearly. Now you are on the track, right? So that is the simple way. So you can see, you can show in years like 2.5, then 0.3.5 you can convert into number of months by multiplying 12, right? Here same, this one also same, 3.3. So again we can 0.3 convert into month, then this become 3 years and 4 months, right? Then so how to make the decision based on this payback period? Shorter payback periods are better, right? Shorter payback period are better. Then payback period, that means computed payback period, if it is less than the policy maximum payback period, then we can accept it. However, computed payback period is greater than the policy maximum payback period given by the management, so we have to reject the project. So that is the way of doing that. If we have a mutually exclusive project, right? Mutually exclusive mean, so we can, mutually exclusive mean we have to take the lowest one, right? Then lowest payback we can accept, right? So that is the way of this one. Then what are the weakness of this method? Now actually this is a traditional method. It has some drawbacks as well, right? What are the weaknesses? What are the strength of this one? Easy to understand, easy to calculate, all are plus point of this particular method. But weaknesses are ignore the time value. අපිට මේ මුදල් හම්බෙන කාලය වැදගත්, ඒකෙත් වටිනාකම තියෙනවා. ඒක time value of money කියලා එකක් තියෙනවා. අද ලැබෙන රුපියල්ක වටිනාකම දෙකකින් තුනකින් හතරකින් පහකින් ලැබෙනකොට තියෙන. ඒ නිසා we have to, when you are making decision, actually we have to think about the time value of money as well. But here in this method, it doesn't consider the money value of that mean time value of money, right? That is one or the weakness of this particular method. Then another one, ignore cash flows after the payback period. Then payback period එක දක්වා විතරයි අපි cash flow එක calculate කරන්නේ. එතන එහා පැත්තට ඒක කවුරුනාට පස්සේ එනම් cash flows අඩුද වැඩිද කියන එක අපි මෙතනදී measure කරන්නේ නැහැ. That is another weak point of this particular method, right? I think that is also important. Not include, it is not enough to calculate. So you should be able to mention the merits and demerits of each and every capital budgeting technique, right? That part also important. In examination also we will check your knowledge on that matter, right? Right. Then if we think about this one, now I told that now if you go to the payback period method, it has some uh, demerits or disadvantages of using this one, right? What are the disadvantages I mentioned? Time value of money, we didn't consider the time value of money, right? Another one, we consider only the cash flows up to recovery of this particular investment. After that, we are not going to consider. Then if you go to this particular method calculation, you can clearly understand. So if you go to the project gold and project silver, you have two types of project here. Then with the similar initial investment is samanai $50,000. Year one we can recover 5,000. Year two we can recover 5,000. So please compute your payback period. Please manually compute by using that particular table. Take only to do that. Doctors, can you do that?
Yes.
Yeah, 3 years each. You can see the payback, right? Payback period is given for project gold is this project silver also this much. So which is the most suitable project now? So how to determine? How determine which is the most suitable one? So you cannot determine because you are given the same answer, right? Same answer. But if you think about time value of money, so you can, out of 50,000, so you can recover 40,000 within the first year, right? Therefore, it will be the great opportunity to that is based on your experience technique, we can decide it. But within the payback period technique, we cannot make that kind of decision. So, point of this particular method, right? So we are not considering. This is a good example for that. Then we don't consider about the time value of money. That is decision, right? Right. Now, if you go to this one, please you can compute and get the experience to compute this payback period for both X and Y, project X and Y. Again, take only 1 or 2 minutes. මොකක්ද හොඳ ප්‍රොජෙක්ට් එක? මේකට අනුව හොඳ ප්‍රොජෙක්ට් එක මොකක්ද? payback period method එකට අනුව. What is the better project as per the payback period technique? Yeah. Your investment is 10,000 each, right? 10,000 each. Then within 2 years time, so you can recover 10,000 as per the project A. Then this 10,000 you can recover for 3,000, then 7,000, then 10,000 within 3 years time, right? So here the payback period is 3 years. So what is the decision? Which is the most suitable project as per the method?
X project.
Project X. Project X. right? Then is it suitable as per your view without considering this particular method? අපි 10,000ක් ඉන්වෙස්ට් කරනකොට 10,000ක් ඉන්වෙස්ට් කරනකොට මේක පළවෙනි අවුරුද්ද එකේ හම්බුනාට ඊළඟට කෑෂ් ෆ්ලෝස් බොහොම පොඩි. හැබැයි මේකට ගියොත් එහෙම අපිට අවුරුදු 3ක් යනවා මේ ටික රිකවර් කරගන්න. but ඊට පස්සේ තියෙනවත් we can say large amount of cash flow කියන benefit අපිට නැති වෙලා යනවා. Right, that is the weak point of this particular method, right? We are considering the cash flows up to this payback period, right? Period, the cash flows are not considered by this particular method. Weak point of so there is a good example for second issues, right? What is the second issue? We are not considering the time value. So we are not cash flows after other period of other issue. Padil, is it clear for you, doctor?
Yes, sir. Clear.
Right, good, right. Here again a previous example here to calculate that. Then move to the next traditional method, that is called accounting rate of return or the average rate of return. Accounting rate of return or the average rate of return. Normally we say we are saying ARR. So this is the way of calculating ARR. Normally the second formula is the better one, average profit per annum per year divided by average investment into 100, right? That is the normal way of obtaining the payback period, right? Then initial investment plus salvage value, that is the residual value at the end. or සුම්බුන්නගේ initial investment එකයි ඒ දෙක එකතු කරලා දෙකෙන් බෙදලා ඊට අමතරව additional working capital එකක් තියෙනවා නම් ඒක එකතු කරන්න ඕනේ, right? Or average investment equals, right, depreciable investment divided by 2 plus salvage value additional working capital. මේකේ තියෙන එක weak point එකක් තමයි මේ වගේ එක එක ක්‍රම වලට ගණනය කරන්න පුළුවන්. එතකොට ඒ නිසා මේ comparison එකේදී සමහර ගැටලු වෙනවා. එකම ක්‍රමය පාවිච්චි කරලා අපි කොහොම හරි මේක calculate කරන්න අවශ්‍යයි, right? So it is also we can use the it is very simple method. So you can obtain the average profit of that particular project, then divide by the initial investment or the average investment into 100. So you can get answer as a percentage, right? Percentage එකක් වශයෙන් උත්තරේ ගන්න පුළුවන්. So if we go back to the here, this here you can see initial cost of that particular new machine we are going to purchase here 500,000 rupees. Expected useful lifetime is 4 years. Residual value is none, right? Salvage value එකක් නැහැ. Expected net annual cash annual not cash flows, right? Don't mix this one. If we are going to calculate the accounting rate of return or the ARR, annual average rate of return or ARR, at that time we are getting profit, not the cash flows. For all other methods are concerned about the cash flows after tax. Cash flows after tax, that is the net input for payback period, net present value, IRR, and all other technique except ARR. ARR වලට විතරයි වචනයෙන්ම කියන්නේ accounting rate of return, accounting profit එක තමයි ගන්න, right? So that is average estimated average net annual income divided by average investment, right? So in this case, you can multiply this by 100 actually, multiply this by 100, right? So estimated average investment total income during 4 years time. So then if you want to take the annual net income, so this you have to divide this by 4. Then you can see the answer as 50,000, right? 50,000. Then the you can see the average investment mean. So how to calculate the average investment? Average investment equal this is the initial investment plus salvage value or the scrap value. Salvage value divide by 2. සුම්බුන්නගේ එකතු කරන්න ඕන initial cost එක 500,000. In this case salvage value is none means 0, right? 0 divide by 2. So then your answer is 250,000, right? Then you can see 250,000 here into 100, right? Then you can obtain here your answer is 50,000, or 250,000 into 100 mean 20%. 20%. Is it okay? Is it okay, doctors?
Yes, sir.
Doctors, can you hear me?
Yes, sir.
Yeah.
Okay.
Then you can take down other questions with the same data, right? I will check only one figure. So take down this one, right? Separately take down in one, right? Instead of the none. So if I give, right, your rest value is 100,000, or the salvage value or the scrap value is sumunnage lakshya. You can use only this formula, right? Even we have number of options, then don't go for that. So then you can select this one only, right? Right? Tell me the answer. What is the answer? ARR, accounting rate of return, or the average rate of return? ARR. What is the answer? Doctors, can you hear me well? Yes? Can you hear me well?
Yes, sir.
Right. Then what is the answer?
16.
16.
16.6.
60?
16.2%.
2%.
16%.
16. Right. Now we will do that. So then your numerator remain the same, right? Numerator remain the same. Am I correct? Then your total income is 4 years, 200,000. Now this project is 4 years, then divide by 2 is 50%. This is remain the same. Investment. So how to obtain the average investment? The previously we obtained 500 initial cost plus 0. Now instead of 0, now you have to take the 100,000, right? Then your answer is, yeah, what is the answer? 300,000 instead of 250. Now your answer is 300,000, right? That is the only change, right? Then 50,000 over 300,000 into 100 mean, what is the answer? What is the answer?
16.6.
16.67%,
16.6%.
right? So this is the answer, right? So I think you can easily compute it. So then after computing it, if it is management given RR, so then we can accept it. However, our value, computed value is less than the management given value, so we have to reject the project. So that is the selection criteria. So another example, you can see another example. So then how to calculate the accounting rate of return? Divided by average into 100. So you can compare proposal or project proposal A and project proposal B. Then in this case, actually, A is better than B when comparing with A and B. But if the manager your expected minimum required rate of return is 30%, so you cannot accept even A or B, right? But if the management says if they accept payback, average rate of return uh, uh, 20 or above it, or minimum of 20% or minimum of 18%, 15%, so we can accept the highest one as here project A, we can accept it at that time, right? Right. Then if I move to this example, so please compute the payback period of this example by using the second method, right? So average investment divided by so first method, average investment divided by average average annual profit or income divided by average investment, right? So you can again consider the previous formula as mentioned previously here, this formula to calculate it. So estimated average net annual cash flows divided by average investment. So the way initial investment plus salvage value by 2. You can follow the same procedure for this example. So here it is important to know. So here if you are given cash flows, right? You are given uh, uh, ARR, you must have profit rather than the cash flows, right? Profit after tax. You should have profit after cash flows after tax. Therefore, you should be able to convert cash flows into profit to calculate ARR. If you have profit, so then you have to convert profit after tax into cash flows after tax in order to calculate other measures like payback period, net present value, profitability index, IRR, and so on. So if you want to calculate ARR only, then you have to have profit after tax, right? Doctors, is it clear for you? Can you understand, doctors?
Yes, sir.
Yeah, then if we want to calculate accounting rate of return, you must have profit rather than the cash flows, profit after tax. But here you are given annual net cash inflows. So how to convert this net annual cash inflows into it? So here only one change here. If we have now, you should have, yeah, you want to take uh, profit after tax, right? Profit after tax. This is for calculating ARR. So how to obtain this one? If we have cash flows after tax, right? Then you have reduced this from depreciation. Depreciation. What is that depreciation? Depreciation means then reducing the assets right? So yeah, that is the formula. So you can obtain this depreciation value. This is similar to initial cost, right? Or initial investment, initial cost or investment minus salvage value, salvage or the residual value, divided by lifetime of the project, lifetime of the project, right? So therefore depreciation is, yeah, initial cost of this particular investment is 28,550 minus salvage value, it is given as 0, right? Divide by number of years or the lifetime is 4. So your answer is depreciation is, tell me the answer. Depreciation is, what is the amount of depreciation obtained from here? Just please tell me.
$7,137.5.
Yeah, 7,130, approximately 8, right? Am I correct?
Yes.
Yes, sir.
Right. This is the depreciation amount, right? So in order to obtain, yeah, you can follow this procedure to obtain the profit after tax. So again, profit after tax equal cash flows after tax. That is here, if we take here, cash flows after tax is here minus annual net cash flows, then minus depreciation amount 7,138, right? Then tell me the answer. Tell me the answer.
$2,862.
62.
62, right? Then we obtain profit after tax, right? This is the annual, no? This is the average profit, right? Then average profit is this much, not for the total profit. Now you are given the 2,862 as you said, right? Then the average investment. So how to obtain average investment? Average investment. So how to calculate it? Average investment is, yeah, initial cost or plus salvage value or the residual value, divide by 2. In this case, initial investment is 28,550, right? Plus salvage value, it is given as 0 here, then divide by 2. So what is the answer? Yeah, 14,000. Yeah, 14,000.
275.
275, right? Then here you have to apply this amount here, 14,275 into 100, right? This divide by here into 100. So what will be the answer? Right? Tell me the answer. 208,062 divided by 14,275 into 100.
2%.
Yeah, right. So you can 20% now. $14,275.
20%.
20%. This is the answer, right? Don't go to this one, right? You will mix this one, right? This is the correct one. So I expect this one, right? Even we have alternative, so you can go to here, right? So see this example, then compute ARR. Here you are given your sales, then the cash expenses, depreciation, so earning or profit, right? Earning or profit or earnings before tax, then after tax reduction of 40%. This is the net income or profit after tax, right? Directly you are given profit after tax for each year. Then here we can see for 5 years lifetime of this particular project. If the initial investment is 200,000, initial investment is 200,000, right? Lifetime is 5, initial investment is 200,000. Then how to calculate the ARR, accounting rate of return, or the average rate of return. So then see this one. Okay. Doctors, can you see? Can you hear me well? Am I audible?
Yes, sir.
All right. So here you should careful with that, because when you are getting the average mean, so you have to take the total and take divide by 5 to take the average. So when you are getting the total, here you can see the -1 profit. This is not the profit, actually loss. So you have to take the total of these 4 and reduce 6,000 from here, then divide by 5. Then only you can go for the average value, that is 40,000. Then your answer is this much. So initial investment is initial investment is what is the initial investment? That is 100,000. No? So 200,000 divide plus 0 divided by 2. Right. So I have got this answer, doctors. Is it clear? Is it clear? Is it clear? Doctors? Am I audible? Doctors? Tell me the average. Average of these these five. Then 6,000 plus 24,000, that is 30,000 plus 48,000, that is 78,000 plus 18,000, then 88, 96,000 minus 6,000, your answer may be 90,000. Then 90,000 divided by 6 years, your answer is, what is the answer? 15,000. Am I correct? Is that 15,000? I'm not sure. 90,000 is correct. That is 18,000, no? 18,000. 18,000. So then if we take the average of this, then 200,000 plus 0 divided by 2, that is 100,000 into 100. Then your answer is 18%. Right? This answer is 18,000. Then convert into here 18,000. Doctors, is it clear? Is it clear for you?
Yes, sir.
Right. I think now you have you already covered two methods, right? Then again we have to think about the merits and demerits of using ARR or accounting rate of return or the average rate of return. Easy to calculate. Then consider accounting profit or accounting income. Therefore, these two are benefits of using this ARR. What are the demerits? Again, ignore the time value of money, right? Ignore cash flows. Consider only the profit, right? So therefore, we can see another different alternative formulas as well. So those are the demerits of this particular method. So next one is very important thing. Now we have to go for the discounted cash flow technique. Now we already completed traditional methods. Now we move to the time adjusted cash flow technique or the discounted cash flow technique. Then again I will give you another a small break, 10 minutes break. So then again we can uh, come to this net present value. So with the fresh mind, so we can go for the new topic. Is it okay, doctors?
Okay, sir.
Right. Then take only 10 minutes, right? So I will join it again after 10 minutes time. Okay, doctors. Again, we came back to the discussion. I think you all can hear me well. Can you hear me well?
Yes, sir.
Now we move to the next method, that is called net present value. That is under the discounted cash flow technique or the modern technique or time adjusted technique, right? So then here, I think you all can hear me well. Accept, yeah. Then here actually we want to now, if we go to the previous two method, payback period and the accounting rate of return, those are having a, similar issue. That is, yeah, those are not considering the time value of money, right? Therefore, in order to avoid this issue or the demerits, so we can go for the net present value method. Actually, under this method, we are converting future cash flows into today cash flows, right? We are converting future cash flows into today cash flows. Then we compare cash inflows and outflows at the same point in time. Then we can easily compare values. Then we can decide whether we have a gain or net present value or the loss, right? Right. So here you can see the present value table, right? So then what is the time value of money concept is used in many business decision. This concept is an important considerations in capital investment decision, right? So how to obtain the present value of present value actually. So in order to obtain the present value, so you have to here actually this is the formula to obtain the present value. So present value is here present value. This is equal to future value, right? Or future value or A. Otherwise, you can see the annual cash flows divide by 1 plus R power n, right? 1 plus power R power n. For example, if we want to take the 1,000 rupees, if it will receive after 1 year time, so then what is the today value or the present value mean today value of this particular uh, amount, right? So if it is under the 8% interest rate, so 8% interest rate mean R is 8%. 8% mean 0.08, right? 8% mean 0.08 after 1 year time. So then you can divide this 1,000 by 1.08%, right? So then your answer, right? Your answer is 1,000 divided by 1.08. What is the answer? What is the answer? Answer is 925.93, right? 9.25.93, right? So this is the today value of that 1,000, right? It will be received after 1 year period. අවුරුද්දකින් පස්සේ හම්බෙන 1000ක අද වටිනාකම කීයද? 1000 නෙමෙයි ඊට වඩා අඩුයි. Under the 8% interest rate. So 10% interest rate you තවත් වෙනස්, right? 10% interest, this is under the 8% interest rate. So if you take 10% interest rate, what would be the answer? So this answer may be 1,000 divided by 1 plus not 0.8, 10% mean 0.1, right? Answer is that is 909 or something, right? So your answer may be this much, right? Then if we want to convert future value into today value, so we can use this particular option. So we can have two options. So then I will go to the go to one example, right? So I will go to one example. So if I go to this example, right? I think you all can see this PowerPoint, right? Now, if we think about our cost of capital, that is the cost for collecting capital, or this is called required rate of return, return, or discount factor, discount factor, right? Discount factor is 10%. Discount factor, the required rate of return is 10%. Please, yeah, make silent your connection, right? Right now, if you have this particular discount factor, the cost of capital, so then if we assume that now as per the project A, this is the project A, right? Project A, it has a number of years, year 1, 2, 3, 4, 5. So if we assume that we have 5 years, right? Then this is the initial investment. Normally initial investment at year 0, right? Initial investment today mean year 0. If we assume that our initial investment is 100,000, initial investment is 100,000, right? Then net annual cash flows, net annual cash inflows, here if it is 25,000, 35,000, then 30,000, 25,000, 20,000, right? So now how can I compare our initial investment with future cash inflows? It is not suitable to compare directly this one without converting into today value. Therefore, our main task is to convert this into not net present value, present value. So how to convert this into present value? So then we have to convert each figures into today value, year 0 value, right? If you convert them into year 0 value, then easily you can compare, right? You can compare, right? This into, then if we compare this, convert this into today value, right? Today value, this total is called present value of cash inflows, right? So you can take this total, present value of cash inflows, initial investment here. So then you can obtain the net present value equal to present value of cash inflows minus present value of cash outflows, or the initial investment, right? Then how to convert this into today value? We can convert this into today value by using the previous formula. So previously we use then the future value divided by 1 plus r power n, right? So for the year 1 you have to apply 1 instead of n. For year 2, so you have to apply 2. For year 3 you have to apply 3 instead of n. Likewise, you can obtain these figures so in this way, right? So how to do that? So you can go to this one. 25,000 divided by then 1 plus R is 10%. 10% mean 1.0, 0.10, sorry, 0.10 power 1. Next one, 35,000. How to convert into today value? 35,000 divided by 1 plus 0, 1, 0 power 2. Next one, 30,000. How to convert it? 30,000 divided by 1 point, again 10 power 3. Next one, 25,000 divided by 1 plus 0, 10 power 4. Last one, 20,000 you can convert 1 plus 0, 10 power 5. So directly you can write it as, right? Write it as, actually you can write it as here 25,000 first one divided by 1.10 power 1. Next one, 35,000, this one divided by 1.10 power 2. This one, 30,000 divided by 1.10 power 3. Next one, 25,000 divided by 1.10 power 4. For the year 5, 20,000 divided by 1.10 power 5. So then you can obtain the answer. So tell me the answer. Tell me the answer instead of here. Please tell me answer. 25,000 divided by 1.1. What is the answer? Please tell me the answer. Approximate answer. Yeah. Yeah. 22,000. Tell me.
727.
227. Then we go to the next one. 35,000 divided by 1.10 power 2. Yeah, what is the answer? Approximate value? Yeah, 28,000.
925.
Yeah, 926. No. Yeah.
26.
25, sir.
Yeah. Okay. Then if you go to next one, 30,000 divided by here 1.1 power 3. 30,000 divided by 1.1 power 3. Yeah, what is the answer? 22,000.
539.
539. Next one, 25,000 divided by, yeah, 1.1 power 4. Then answer is 17,075. Am I correct? $17,075. Last one, 20,000 divided by 1.1 power 5. Answer is 12,480. Am I correct? Then take the total. total. Take this total of these 5 items. Yeah. Yeah.
103,635.
103,000. Yeah.
635.
103,685. Right. So then we can,
35.
yeah, then we can 35, 85,
35.
85, no? 85 or 35.
85. 85.
Right, right. Check whether it is right. Then NPV, this is the formula to obtain the NPV, right? So NPV means net present value, net present value, right? Net present value mean NPV, right? NPV equal present value of cash inflows. We already obtained net NPV equal present value of cash inflows. This is the present value. Present here, present value of cash inflows here. Then we can substitute to here. That is 103,685 minus present value of cash inflows. Actually, no need to calculate. Present value of cash inflows mean initial investment, right? Today present value is 100,000 mean initial present value also same, right? Then 100,000. So after reducing this one, NPV is plus 3,685, right? What is the decision criteria? Decision criteria is if NPV greater than or equals 0, accept the project. Accept the project. Accept the project. If NPV greater than or equal, then you can accept the project. Right? This is the overall process of obtaining this particular results. Right? Then here this is regarding the discount factor. If you take the discount factor separately from this particular value, then here 25,000 divided by 1.10 power 1. So you can write this the similar way, 25,000, right? 25,000 multiplied by 1 over 1.10 power 1. Ultimately, you can see the same answer, no? Right? Then 25,000 over 1.10. Here also 35,000, you can write it here. 35,000 equal 1 over 1.10 power 2. Another one, 30,000. 30,000 into 1.10 over power 3. Another one, 25,000. 25,000 into 1.1 over 0.4. Right? Last one, 20,000. 20,000 into 1.10 power 5. Right? then ultimately you can see the same answer, right? Ultimately you can see the same answer, right? This value is called, tell me the value of this one. Tell me the value of this one. 1 divided by 1.10, right? 1 divided by 1.10 power 2. 1 divided by here 1. 1 divided by here also same. 1 divided by 1 divided by 1 divided by 1.0 power 3. 1 divided by 1.0 power 4. 1 divided by 1.0 power 5. So tell me the answer. This one 0.909. Am I correct?
Yes, sir.
Yes, sir.
The next one 0.827. Am I correct? Am I correct?
Yes, sir.
Right. Then next one. Tell me the next one. 0.1 divided by 1.0 power 3. Yeah.
0.751.
Oh yeah. 751. Next one. Point
0.682.
8682.
2.
Oh, 1 or 2? 2. Okay. Right. Next one. Last one.
0.620.
6201. No. 621.
6206. Tamai, sir.
Yes.
6206.
Yeah. Then 01. No. Or 5. No. After getting the approximate value 621. Right. Okay. Now then here these are called discount factors. These are called discount factors. Discount factor. Discount factors. So actually, without going into this lengthy process, if you have cash flows, directly you can multiply this by discount factor. This is remain constant. If it is 10%, you can see this discount factor, right? So you can obtain from the discount factor table as well, right? Percent value table. Then directly you can multiply. For example, so you have 25,000. What is the relevant discount factor? 0.90. So multiply this one. 25,000 by 0.909. What is the answer? What is the answer? Tell me the answer. Please tell me the answer.
22,725.
25. Now we can see similar type of answer, right? Right. Yeah. Next one. Don't worry about 25 and 27, right? Then if we multiply 35,000 by 0.827, what will be the answer?
28,945.
Yeah, 28,945.
45.
Previously 26, right? Don't worry. Now you can see closer value here, right? Next one, 30,000 into 0.751. What is the answer?
22,530.
30, right? Now 39 here, 30. Then you can see the approximate value from that, right? Then next one, 0.681 into 25,000. What would be the answer? 17,075 or closer value you can see. Can you see that? Can you see that?
17,050.
17,050, right? The closer value here. Then if you go to next one, 20,000 into here 6.21. What is the answer?
12,420.
That is wrong. 12,000, no?
12,420.
12,420.
I got as 5,000. 12,000 is correct. 12,120. Yeah, it is 18, no? 1820, right? This crosser, right? Then without going into this lengthy calculation, right? You are given the discount factor in your table, right? So if you refer different financial management paper books, you can see a discount factor table at the end of the book, right? So then directly you can obtain these figures from the book, right? Then you can multiply cash flows by this particular or respective values. Then you can obtain the present value. No need to go for this lengthy process, right? So then you can obtain similar answer, closer answer for that, right? Then ultimately you can go for the similar results and similar decision you can make, right? So if I go back to go to the particular same example, so tell me that. So now we have year 1, year 0, 1, 2, 3, 4 and 5. What are the cash flows? Then discount factor is 10%, right? Then initial investment is 100,000. Cash flows are, right, net annual cash flows. Here first one 35,000, next one 30,000. Am I correct? Oh, 25. Yeah, first one 25,000, no? Right. First one 25,000. Next one 35,000. Then 30,000. 25,000.
20,000.
20,000. Then we can get discount factor under the 10%, right? 10% discount factor. This one, this becomes 0, 1. Huh? This is 1. Discount factor for here, you can obtain from the table, right? Now you can see if it is a 10% discount factor. So what is the year 1? You are given as 909. Year 2, 826. Year 3, 751. Year 4, 6.683. Year 5, 0.621. Year 6, 0.564. Likewise, you are given, if it is 15%, you can see different discount factor, right? You are given discount factor, right? Then you have to multiply each cash flow by the respective discount factor. So we can take down this discount factor. Yeah, first one discount factor, this is 1. No need to have within bracket, right? So then this is 909. This is so I will take a different count, right?
826.
0.909, 0.826, 0.751, 0.683, 0.621, no?
621.
621, right? This is the present value. Now you can multiply this one 100,000 into 1 mean again same answer within bracket. Now this one 25,000 into 0.909. So tell me the answer. Yeah, we can save time, right? So you can provide answers, right? Yeah, 22,000. Yeah, 22,000. Doctors, please tell me.
22,725.
25. Right. Next one, 35,000 into 0.826. You have to multiply these two, these two, these two, these two, and so on, right? So tell me,
28,920.
20,
910.
910, right? Next one, 13 to 0.35, 22,000 something, no?
22,530.
Next one, 0.63, 3683 into 25,000, 17,000 and 50. What is the answer?
17,075.
17,025. The last one,
12,420.
420. So this is called, if you take this total, this is the present value of cash inflows. Present value of cash inflows. What is the answer? Total.
$103,660.
606.
60.
Right? 60.
660.
Right. Now we can calculate net present value. Net present value or NPV equals present value of cash inflows minus present value of cash outflows, so the outlays. This is the initial investment actually, right? Then you can obtain answer for here. Net present value equals present value of cash inflows is 103,660 as you said, minus initial, this is the present value of cash inflows, so the initial investment, right? Then your NPV is 3,660. So it is closer to the previous one also, right? Previously here 3,685, right? Then if your P value, sorry, NPV, NPV value greater than 0, greater than or equal 0, you can accept the project. So now here you can accept because P value, NPV value greater than uh, 0, right? Oh, yeah. Then positive value, NPV positive, then you can accept, right? NPV positive, therefore you can accept the project. You can accept the project, right? Now, no need to go for the lengthy calculation like previous one. Easily you can obtain cash flows. Then you can multiply this by respective discount factor. Then you can obtain present value, right? You can easily obtain the present value. Then go for the total. This is called present value of cash inflows. So you can obtain this figure. So then you can substitute here present value of cash inflows. Then this is the present value of cash outflows. So then we can take the net value. If it is greater than or equal 0 or positive, you can accept the project. right? I think you have clear idea about it. Doctors, is it clear for you? Is it clear?
Yes, sir.
Right, right. Then if it is clear, so you can actually, what is the idea behind that? Now, if it, yeah, yeah, don't become a machine to understand this one. So here you should be able to understand what is this discount factor. So discount factor mean, so here we are multiplying this by 0.906. මොකද්ද මේකේ අදහස? 0.906 කියන්නේ අපිට අවුරුද්දකින් පස්සේ රුපියලක අද වටිනාකම රුපියලක් නෙමෙයි 790.9යි. හරි, ඊට වඩා අඩුයි කියන එකයි කියන්නේ. හරිද? ඒතර අවුරුදු දෙකකට පස්සේ අපිට හම්බුනොත් රුපියලක් ඒකේ වටිනාකම රුපියල නෙමෙයි 782.06යි. හරි? දැන් අවුරුදු 3ක් පස්සේ අපිට රුපියලක් හම්බුනොත් ඒක රුපියල නෙමෙයි වටිනාකම 775යි ආසන්න වශයෙන්. හරි? ඒතර අවුරුදු 4ක් අවසානයේ අපිට ලැබෙන වටිනාකම රුපියලක අද වටිනාකම 768ක් ආසන්න වශයෙන්. අවුරුදු 5ක් අවසානයේදී අපිට ලැබුණොත් රුපියලක් ඒකේ අද වටිනාකම 762යි ආසන්න වශයෙන්. හරි, ඒකයි මේ අදහස් කරන්නේ ඩිස්කවුන්ට් ෆැක්ටර් කියන්නේ ඒකයි. නැත්නම් යාන්ත්‍රිකව මත තියාගන්න යන්න උත්සාහ ගන්න එපා. හරි, එක්සෑම් එකේදී හරි නැත්නම් ඕනම වෙලාවක අපි මොනවා ඩිසිෂන් මේකින් ගන්න වෙලාවක මේ මේට්‍රික්ස් එක අපිට වෙබ් එකට ගිහිල්ලා හරි ප්‍රසන්ට් වැලියු ටේබල් කියලා ගහපුවම එනවා. හරි, නැත්නම් පොතක් අපිට ෆයිනෑන්ෂල් මැනේජ්මන්ට් හරි මැනේජ්මන්ට් අකවුන්ටිං පොත්වල අවසානයේ මේ ඩිස්කවුන්ට් ෆැක්ටර් ටේබල් එක තියෙනවා. මේක තමයි ඩිස්කවුන්ට් ෆැක්ටර් ටේබල් එක. හරි. හරි, ඒතර මේ මම මේ උදාහරණ වශයෙන් ගත්තේ මේ 6යි 10යි 12යි එහෙම නෙමෙයි. මේක අවුරුදු ගානකට පල්ලෙහාට තියෙනවා. මේක 102 104 106 105 ඕන ඉලක්කමකට අදාළව ඩිස්කවුන්ට් ෆැක්ටර් එක තියෙනවා. ඒ ඩිස්කවුන්ට් ෆැක්ටර් ටේබල් වල. හරි, දැන් අපිට අදාළ වෙන්නේ අපි හිතමු අපිට ඕනේ කියලා තුන්වෙනි අවුරුද්ද 112 යටතේ එන්න මෙන්න අදාළ ඩිස්කවුන්ට් ෆැක්ටර් එක 0.71 2. හරි, අපිට ඕන කියමු 115 යටතේ අවුරුදු 3 0.6යි 5යි 8යි. ඉතින් මේ විදිහට අපිට හොයාගන්න පුළුවන් වෙන්න ඕනේ. ඒතර මේකේ අදහස් කරන්නේ 112 නම් ඩිස්කවුන්ට් ෆැක්ටර් එක අවුරුදු 3ක් අවසානයේ ලැබෙන රුපියලක අද වටිනාකම 0.71 2යි. ඒතර රුපියලක අද වටිනාකම ඒක නම් හරි, එහෙමනම් අපිට ඕන වෙනවා රුපියලක අද වටිනාකම අවුරුද්දක් පස්සට පස්සේ ලැබෙන එකේ අද වටිනාකම 9.90.9යි. එහෙනම් රුපියල් 25000 කීයද බලන්න. එහෙනම් රුපියලක එක වැඩි කරනකොට 25000. මෙතන රුපියලක වැඩි කරන්න ඕනේ 35000. රුපියලක අද වටිනාකම වැඩි කරන්න ඕන 30000. මේ විදිහට වැඩි කරලා percent value එක මේ විදිහට හොයාගෙන ඒ ඔක්කොගෙම එකතු අරන් ඉවරලා ඒ එකතුවෙන් initial investment එකේ අද වටිනාකම ඒකමයි. ඒකෙන් ඒක අඩු කරාට පස්සේ අපිට එනවා NPV බිඳුව හෝ ධනාගයක් එනවා නම් අපිට පුළුවන් ප්‍රොජෙක්ට් එක ඇක්සෙප්ට් කරන්න. එහෙම නැත්නම් ප්‍රොජෙක්ට් එක රිජෙක්ට් කරන්න. හරි, ඒතකොට ප්‍රොජෙක්ට් ගොඩක් තිබ්බොත් එහෙම අපි වඩා ධනාගය වැඩි එක අපි තෝරගන්න පුළුවන්. ඒක තීරණය වෙන්නේ අපේ ව්‍යාපෘතියේ සංඛ්‍යාව සහ ව්‍යාපෘති ස්වභාවය අනුව. අපේ තියෙන මියුචුවල් එක්ස්ක්ලූසිව් නම් වැඩිම එක තෝරගන්නවා, අනිත් ඒවා තෝරගන්න බැරි වෙනවා. එතකොට ධන ඒවා කීපයක් තියෙන අවස්ථාවකදී අපිට අවශ්‍ය ෆන්ඩ්ස් තියෙනවා නම් ඉන්ඩිපෙන්ඩන්ට් නම් කීපයක් වුණත් තෝරගන්න පුළුවන්. හැබැයි කන්ඩිෂන් එක තමයි NPV සමාන වෙන්න ඕන බිඳුවට හෝ එහෙම නැත්නම් වැඩි වෙන්න ඕන. හරි, is it clear? Is it clear for you, doctors?
Yes, sir. Clear.
Right, I think you got clearly this important idea, right? This is not easy to teach, right? I got number of mathematical approach to teach it, right? Right, I think now you got clearly this point, right? Right, now you are given this example, right? That would be true if the net cash flows remain constant from 2006 through 2031. Not that cash flows 70,000, 60,000, 50,000, 60,000 and 40,000. So how to convert this particular amount into today values? So you can if it is 10%, so you can convert into today values, right? So then this is the example, right, for the present value table. So you can use, if it is 10%, right, you can see 10%. You can select 10% for year one. This is this much. For year two, So then you can see 0.8826, year 3, year 4, year 5, year 6, year 7, 7, 8, 9, 10, anyone you can take. Now, if your discount factor is 15%, year 1, 2, 3, 4, if discount factor is 25%, year 1, 2, 3, 4, 5, so and so on. So you can select this one. If your discount factor is 6%, so here you have year 1, year 2, year 3, year 4, right? So when it's come to the lower discount rate, you can see comparatively higher value. Now here for the year 1, under the 10%, 0.901. But if you go to the under the 7%, so you can see 0.935. Again, රුපියලක 10 වට්ටම් සාධකයක් රුපියලක අද වටනාකම හෙට ලබන අවුරුද්දේ ලැබෙන රුපියලක අද වටනාකම 790.9යි. මේක 7ක් වුණොත් එහෙම ඒ අවුරුද්දක් අවසානයේ ලැබෙන රුපියලක අද වටනාකම ඊට වඩා වැඩි මේ 790.9ට වඩා වැඩි 793.5යි. ඒතර මේ පැත්තට එන්න discount rate එක අඩු වෙන්න present value එක වැඩි වෙනවා. Then you need to know what is the relationship between discount factor and the present value. When increase the discount factor, present value will decrease. So then we can see a negative relationship between discount factor and the present value. That also should know, right? Right. Now this is the way of calculating. So this is a decision. If NPV greater than or equal 0, accept the project. If it is less than 0, so reject the project. Right? So now you are given one project, right? So now please, this is the similar example. We got this for payback period as well, right? Now you have to calculate the NPV. So for this example, please compute NPV, right? We got it for calculate NPV, right? Under the 10% level, right? You are given 5 minutes, right? 5 minutes to calculate it, right? Then compute payback period for project A and project B. Payback period for project A and project B. Can you calculate it, doctors? Doctors, can you calculate?
Yes, sir.
Yeah, you can obtain 10% discount rate from the previous tables, right? Here, you can obtain it, right? Then separately calculate. Yeah, take the project A, right? Like this, right? Like this. This is project A. Then again, separate one you can open. That is project B. Then calculate the NPV for project A and B. So ultimately, we can make the decision, right? Take just a 5 minutes, huh? Okay. I think now you all can see this PowerPoint. So the way of calculating, can you hear me well, doctor?
Yes, sir.
Yes, sir.
Yes, sir.
I think you already obtained the answer, right? Then here you can write it as here, year 1. This is regarding project A, yeah? Project A. Project A. Then year 0, year 1, year 2, year 3, year 4, right? Then initial investment, it is 42,000. It is important to put here bracket, huh? Because cash outflow here. If it is a cash outflow, you have to put bracket. If it is cash inflows, then you can write it as in normal way, right? Then cash net annual cash inflows, after tax, right? After tax. Then it is given as 14,000 for the year 1, again 14,000 for the year 1, 14,000, 14,000 for 4 years time, right? Then if it is 10% discount rate, so then you can see discount factor under the 10%. You can obtain as previously. This is normally 1. This is 0.909. You can obtain from the table. This is 826, right? This is here 0.751, right? And bracket is not important, right? No need to put here bracket. Then this is 0.683 also, right? So then, then if we take present value, yes, present value, this is 2,000 cash outflow. This one, tell me the answer.
12,726.
26.
Right. Next one.
11,564.
Next one.
10,514.
Last one.
9,562.
Right. And take the total of here. This is the present value of cash inflows. Yeah.
$53.
50.
Sir, first one 12,726.
First one is 12,726.
Okay.
Oh,
Tell
I
me.
see.
There is one more, yes, sir. 5 years. We need 5 years.
5 years. Sorry.
623. Yes.
Yeah. What is the last one?
8,694.
8,694.
Okay. And tell me the total.
53.
53,060.
60.
Right. Then
Not zero.
3,000.
Not
53060.
53.
0.
This one.
066.
Yes, yes. Yes.
Right. Then we can calculate net present value. This is equal to present value of cash inflows minus present value of cash outflows or the initial investment. Right. Then NPV equals 53,060 minus 40.
2.
Right. Then your answer
11,050.
11,060.
60.
that is positive.
Yes.
Right. NPV
Yes.
positive. So then NPV greater than or equal 0, then accept the project. right?
Yes.
Then similarly, you can go for the project B as well, right? So how to, yes, I'm not going to waste much time, but here easily you can apply instead of 14,000, you have to apply 28,000 here. This is 12,000. This is 10,000, right? This is again 10,000. Again 10,000.
Yes.
So this is remain the same, right? No need to change it, right? Then this is also same. So then you can see a different answer for here. 28,000 into point 9. Yeah,
25 for 452.
25,052.
452.
Next one.
9,912.
Okay. Next.
7,510.
7,510.
Okay.
6,830.
Okay.
6,210.
Okay. Total.
Total 55,914.
Right. So here you can substitute values here. This one 55,914. This one
Minus 45.
initial investment 45,000, right? Then you
Yeah.
answer 10,000
914.
974.
940, right? Then this is 900,
14.
14, sir.
right? 14. Okay, right. Now you can see here. Previous one, your NPV is greater than this one, right? If it is a mutually exclusive project, so you have to accept A, right? Because B has a lower NPV than the A, right? But if you have independent two projects, so you can accept both, right? That is the way of making decision, right? Have got my point, doctors?
Yes, sir.
Right, right. So here, then you can see number of examples here. If it is, yeah, you can see the independent project. So how to accept or reject the project under the NPV. Accepting or rejecting one project has no impact on other project. That is called independent project. Mutually exclusive mean if we accept one project, so we definitely we have to reject another project. So all other projects, right? So that is the mutually exclusive project. So then how to make decision under the normally we have to think if NPV greater than or equal 0, so we can accept the project. If it is NPV less than 0, we can reject the project. If it is mutually exclusive project, so we have to select the highest one, choose the highest one, right? Yeah, there are a number of benefits, pros and cons. That there is the benefits from here. So then it is consider the time value of money, consider the cash flows. Then we can use them for selecting outstanding project out of number of projects. So likewise, so we can see plus point as well, right? Then next one, actually this is very much easy method, that is profitability index method. That is also under the discounted cash flow technique, right? So a profitability index method mean, so here previously we calculate the same thing. So if I go back to the previous example, profitability index of project 1, project A, right? If we go to the project A, right? Project A, then profitability index is here present value of cash inflows. Present value of cash inflows. If we go back to the previous question, here present value of cash inflows, previous one, project A, 53,060, 53,060, right? 53,060. 53,060. Initial investment or the present value of cash inflows is 42,000. Am I correct?
Yes, sir.
So then what is the answer? Tell me the answer. 1 point. Take into 3 decimals, right? 1 point.
1.263. 263.
1
Point
262.
point
265.
260.
263. So this is for project A. So if I go to the project B, right? Project B. So how to calculate? Yeah, present value is 55,000. Tell me the answer. 50,000, 55,000 and
940.
55,540. Am I correct?
940, sir. 914.
914. 55,914. 914. Then this one is initial investment is 45,000. No?
45,000.
Right. Then tell me the answer. 1 point.
242.
2425. 242.
Right. So then which is the highest one? Now you have to select the highest one. First priority goes to the highest one. A for the first priority, B for the second priority. Right? Then what is the criteria? If the profitability index over 1, right, accept the project. Accept the project. If it is less than 1, reject the project. Right? This is very much essential for capital rationing. අපිට ප්‍රාග්ධනයේ බොහොම අඩු ප්‍රමාණයක් නම් තියෙන්නේ මේ ව්‍යාපෘති අතර බෙදා හරින්න ගියාම this method is very much important, right, in order to share in the capital among different investment projects, right? So this profitability index method is very much essential for that. So we have no separate calculation. We can calculate these figures from the NPV table, right? So then ultimately you have to go to this particular method, right? Right. Now you can go to this criteria, independent project. If p value greater than 1, so accept it, right? Mutual project, then we can see the highest one, right? Then in order to, these are the steps in capital rationing. Identify the potential project, eliminate projects that do not meet minimum requirement, then evaluate the remaining projects, right, by using NPV. So you can obtain the NPV and calculate the profitability index. Then we can rank them based on the priority, right? So then here in this case, actually, you can see 2 projects, project A and project B. Project B, you can see a profitability index as 1.1154. Project A, it is 1.10. So then you can see the highest one, right? Here, if you take 3 projects, so you can see present value and total or investment or the initial investment. Then you can obtain the present value. Then highest is B, next is A, then last is C, right? Here, if you think about this one, so here we have only $1,000, right? $1,000 to invest in this particular investment, right? So we have projects, number of projects here, right? Number of projects here. project 1, 2, 3, 4, 5, 6, 7, 8. So then you have to reject the project with NPV minus, right? So you can reject NPV minus. Then here remain 1, 2, 5, 6, 7, 8. These are the good projects, right? Here we have profitability index over 1. So here we have to rank based on the profitability index, right? Based on the profitability index, we can rank them. Then which is the highest one? Profitability index, highest one is here. This is the rank 1, right? Then this is the rank 2. Then here this is the 3. This is 4. 35. Yeah, this is 5. Right? 5. Then this is 6. Right? Then this is the way of selecting. First priority goes to here. So now we have only $1,000 to invest, right? Fixed amount of investment. So starting from 1, for the first priority goes to project 5. So you can invest project 5 in this. The investment portfolio is project 5. Starting from project number 5, the investment amount is here investment or initial outlays mean initial investment is 600, right? Then the second priority goes to here, project 6, then investment is 200, right? Then third priority goes to here, here we can see project 3, 1.37. But the problem here, if you add project 1 here, so you have to have 600 additional capital. But here we have only, total should be tally with the $1,000, right? Therefore, balance here you can see only 200. So 200 you can invest from here. This is the fourth chance, right? So you can go for here. This is the project 2. This is the optimal structure of investment, right? So you can invest 600 from project 5, then another 200 from project 6, and another 200 from project 2. So this is the optimal capital combination, right? So in order to obtain the capital ration in combination, so you can use this kind of profitability index method. Profitability index method, right? Profitability index method එක තියෙනවා අපේ තියෙන සීමිත ප්‍රාග්ධනය මේ කියන ව්‍යාපෘති අතර බෙදා හැරීම සඳහා ඒක පාවිච්චි කරන්න පුළුවන් ඒ රෑන්ක් එක බේස් කරගෙන. Is it okay, doctors? Can you understand that?
Yes, sir.
Doctors? Right. Is it clear?
Yes, sir.
Yes, sir.
Right. So here you are having number of examples, right? You can practice. There are number of example. If it is below point profitability index below 5, below 1, so then you can reject it, right? You can reject, then consider all others, right? That is the first step is to remove the project with profitability index below 1, right? Then go to the limit. You are having only 10,000 investment, right? Or 10 million. 10 lakh, 1 million, right? 10 lakh here. So if we go to the first priority, goes to, what is the first priority? First priority goes to highest
Three.
3.
3. This is the first priority. The second is first, ne?
Yeah.
Yeah. This is the third. This is the fourth. So if you invest in project proposal 1, project proposal 3, so 2, ne? 3, no? 3, yeah. 3. So what is the relevant investment? 500,000. Right. Next one is project 1. relevant amount is 300,000. 300,000. So our total amount available is 1 million. So here further we can invest
Project
only
4.
200,000,
Project
right?
4.
Yeah, yes, project 4. So we can invest in project 4. So this is the optimal investment structure, right? I think you all can easily understand that. When you are making decision, so we can easily understand, right? Actually, if we accept all the projects, so we should have this much of investment, right? All the favorable projects. So this is 300,000. This is 500,000 altogether, 800,000. This is 200,000. That is 1 million. Then 150,000. We should have 11 lakh and 50,000 or 1.15 million, right? But here we have limited to 1 million. Therefore, this is the structure. You have to select 1, 3, and 4. So this is the way of writing your answer. Right. I think you got it clearly. Further, we have a number of example to cover, right? So here you can see a number of example. You can practice it, right? I'm not going to discuss internal rate of return, right? So I think within the limited time, we can cover two method we calculated under the traditional method, payback period, and also the ARR, accounting rate of return. Under the uh, discounted cash flow technique, we use NPV, net present value, and profitability index. In addition to that, actually, I'm not going to discuss, but you can easily understand another method that is called discounted payback period. Discounted payback period means, so after discounting, so again, we are calculating the payback period. After discounting the future cash flows, we can easily compute the uh, payback period. So that is called, that is called discounted payback period. So here you have one slides for that. I think it was there. Yeah, here, this one, discounted payback period. So first one is to calculate the cumulative discount value, cash flows. So then you can prepare the discounted payback period, right? So after getting this kind of table, right? This kind of table, this kind of table, so you can compute the payback, right? Starting from 100,000, so you can cover 22,725 from year 1, this much from year 2, this much from year 3. So then ultimately you can compute the payback period, right? That is only change under the discounted payback period, right? I think you all can easily do that task, right? Further, we have to discuss number of cases. Next time I will discuss those things. Do you have anything to clarify? Do you have anything to clarify, doctors? මොනවද තේරුණාද දෙයක් තියනවද? So you can practice this, yes, these other questions as well, right? Under the profitability index, you are given number of example here. You can practice. Yeah, yeah, you are having only $100,000 to invest. So you are given initial investment and PV, present value of cash inflows. So here you have to calculate profitability index, then rank it, and based on that you can select the most suitable investment portfolio, the investment mix, right? So here you are not given the profitability index, you have to calculate it. Yeah, this is the only change if you compare with the previous one. Then you know that the way of obtaining then present value of cash inflows over present value of cash outflows of the initial investment, then you can obtain the answer for that. Then based on that you can rank. Is it clear, doctors? Can you manage it?
Yes, sir.
Yes, sir.
Right. Then if you are not having any particular issue, so we can wind up the session. මං හිතනවා හොඳටම මේක තේරුණා කියලා. මන්ද මං හිතන එක හරිද කියලා. ડોක්ටර්ස්ලා තමයි කියන්න ඕනේ. Is it clear?
Yes, sir. Clear.
Yes, sir. It is clear.
Right. So then next time further we can discuss some other examples as well, right?
Okay, sir.
Okay, thank you for active
Thank
participation.
you, sir.
Thank you, sir.
Okay.
Thank you, sir.
Thank you, sir.
Okay. Welcome.
Thank you, sir.